If you haven't heard, we had the largest collapse of a bank since 2008, which is none other than the Silicon Valley Bank. Now, what led to this disaster? Let's go check the facts. Now, there are three risks each and every bank faces every day, which could lead to the bankruptcy of any bank around the world. We have credit risk, federal interest rate hike risk, and liquidity risk. Now, what are these three? Let's get into it. Credit risk is simply when the borrower borrows money from the bank and then later on defaults on the said money. Let's take an example. Say let someone borrow money from the bank with a particular interest rate for a specific period of time. Now he is supposed to pay an interest each and every month to the bank. At some point, he fails to pay the said money to the bank and he defaults on his loan. Now here the bank has a problem. Now the bank can seize the assets of the said person to retrieve the money which he has borrowed before. Now this is not going to be a problem for the bank unless a lot of big players defaults on their loans. So bankruptcy through this is a far-fetched idea. Now comes the federal rate interest hike risk. For us to understand how this affects the bank, we need to go back to bonds. What are bonds? Bonds are simply an instrument given by the government or corporates to the investors for a particular period of time for a specific interest rate. For a price, of course. Now here, let's say the government or corporate issues a $1,000 bond at 5% interest rate for 10 years. Now an investor buys this bond from the market, for which he will lend this $1,000 to the government or corporate. He or she will receive $50 each and every year from the government or corporate until the tenure time is over. Here in this case, which is 10 years. Now when you look at it, it's an easy bet. There's no muss or fuss. But the case is going to be different if you're purchasing the bond in larger volumes and you're forced to sell it before the maturity date. So we discussed about this $1,000 bond which was issued by the corporate or government. When the Feds hike the interest rate, the government or corporate will issue new bonds, and the new bonds issued each and every year after this hike is gonna be priced more compared to the old bonds which was issued on the previous year because of course the interest rate. When an investor finds a bond which provides you more interest with the same price, of course he's going to go for that, while the old bonds of the previous year will reduce in price. So the investor who bought the $1,000 bond last year will have the same bond at a lower price, say $950, compared to the new bond which was issued after the rate hike. Say if the new bond is $1,000 this year, the old bond is going to be $950 or even lower. Depends upon the hike of the interest rate. Now let's replace these investors with a bank. Yes, you guessed it, the Silicon Valley Bank. When the Feds increased the interest rate, the bonds which was with the Silicon Valley Bank, which was bought earlier, reduced in its price because the demand of new bonds which was issued after the rate hike was higher. As the demand decreases, the price also decreases. Now the bank doesn't have a problem if they let it ride till the maturity date. But if they are forced to sell it, you guessed it, they have a problem. When the bank invested 55% of its assets in bonds, what they did not expect was the customers withdrawing the funds. Now you all know a bank is going to be a serious issue if customers started withdrawing funds. Obviously, no customers, no funds, no bank. This is exactly what happened with the Silicon Valley Bank. The customers started withdrawing funds out of the blue, and now the bank has to raise money to give the customers. This is what they call liquidity risk. The bank doesn't have enough liquid funds to meet the ends of the customers. Now the bank has to raise money. Now how do they raise money? 55% of its assets are held in bonds. The only way for them to raise money was through selling the bonds. and they sold out the bonds at a cheaper price at a loss of $1.8 billion to raise funds for its depositors. Now all they can think is how to compensate this loss. Okay, the depositors has met their needs, they have the money they want, but in the balance sheet, bank is at a loss of $1.8 billion, and for a bank, that is a big issue. So what they did is, to compensate this loss of $1.8 billion, they decided to raise the funds from the investors. So the bank decided to raise $2 billion from the investors. And what do you think happened when the customers heard about this? What do you think you will do when the bank you have invested all your hard-earned money in needs $2 billion to stay afloat? Of course, you will withdraw the funds. The customers started withdrawing funds back and forth without any mercy. The customers lost faith in the bank. They rushed to the bank to withdraw the funds due to the panic sell in the market. And the thing is, 88% of the money in the bank was uninsured. If you have read the news, you know that the same thing happened with the Signature Bank. Even though the Silicon Valley Bank and the Signature Bank was in line with the regulatory requirements, the assets and cash in hand was not even close with the industry average. While the industry average for other banks for cash in hand was 13%, the Silicon Valley Bank and the Signature Bank was holding 5 and 7% only within them. The industry average for fixed income security was 24% for other banks. The Silicon Valley Bank was at 55%. What is fixed income security? The same thing, bonds. They were holding 55% of their assets in bonds, while other banks were holding merely 24%. Seeing all this, the authorities woke up. They were like, yeah, we should do something. So to avoid the banking crisis, the Treasury Department, the Feds, and the Federal Deposit Insurance Corporation decided to take 3 steps to meet with this crisis and to restore faith in the banking system. First, the FDIC promised to protect the depositors of both the banks, no questions asked. Second, the Feds announced Bank Term Funding Program, offering 1 year of loans to this bank in case of a liquidity crisis met by the bank. Now, these loans were much more easier to grab compared to the other programs which was introduced by the Feds. The third, instead of bailing out the banks, the money for the depositors will come from the FDIC's Deposit Insurance Fund. Meanwhile, the shareholders and debt holders of the bank will be completely wiped out. It is said that the US banks have till now booked $620 billion of unrealized losses due to the rate hikes. Now the real question to ask here is, even after all these steps, will there be a financial crisis like 2008? All you can do is wait and find out. Please subscribe to our channel for more quality content, and thank you for watching.